Navitas Semiconductor Corp., ticker symbol NVTS, is currently trading at 8.47 USD, showing a significant intraday surge of 8.02%. And while many investors glancing at their Robinhood app or Fidelity mobile app might see this as just another volatile day for a small-cap chip stock, what's happening under the surface is a fundamental misreading of the company's new strategic alignment and the immense pressure building in the power electronics market. This 8% junk isn't just noise. It's a signal that the divergence between the popular narrative and the underlying technical reality is starting to close, and a lot of people who thought they understood this company are about to be proven wrong. This is precisely the kind of move that separates casual participants doing basic online investing from serious analysts who are looking at the granular details. The general belief, the widespread expectation about Navitas has been the same for years. It's a story told in broad, optimistic strokes. Gallium nitride, or GaN, is the future of power. It's faster, smaller, and vastly more efficient than the traditional silicon MOSFETs that have powered our electronics for decades. The narrative says that as the world demands more efficiency for data centers, for solar inverters, for electric vehicles, and for our tiny laptop chargers, this advanced material is the obvious successor. Navitas, being one of the only pure-play, vertically integrated GaN companies, is therefore positioned as the designated winner, the next big thing in semiconductors, a potential future peer to the stories of NVIDIA stock or even early Tesla stock. This is the story that gets repeated in forums and simplified for quick investment pitches. It's the story that makes sense when you're just getting started with self-investing and looking for a simple, compelling thesis. But this is where the reality of the market violently disconnects from that clean expectation. The assumption that GaN wins, so NVTS wins, is dangerously simplistic. This isn't a one-horse race. It's a brutal multi-front war. And today's 8.02% move isn't just the market just waking up to the GaN story. It's a reaction to something much more specific. The reality is that this industry is not just about having a better material. It's about manufacturing scale, cost per watt, reliability data, and securing massive long-term design wins. For the past year, the reality for NVTS has been a high cash burn rate, relentless competition from giants like Infineon and Texas Instruments, who are now launching their own GaN products, and a stock price that has been hammered by macroeconomic headwinds. The reality is that while GaN is superior, silicon is incredibly cheap and good enough for many applications, making the adoption curve far slower and more painful than the bulls projected. This stock isn't just a simple technology bet, it's a bet on the timing and cost of a massive industrial transition. So let's break down today's 8% surge. This isn't a random walk. We're seeing unusually high trading volume, well above the 90-day average, and the buying pressure appears focused. This suggests it isn't just retail investors using SoFi Invest or chasing momentum. When we look at the order flow, we're seeing large blocks being absorbed. This could be a single institution, perhaps a Fidelity Wealth Management division, or a specialized tech hedge fund, deciding that the sell-off has been overdone and that the risk-reward ratio has finally skewed positive. They're not using the simple Robinhood stock trading interface. They are likely executing complex algorithms via a professional setup like Interactive Brokers, minimizing their market impact. This kind of focused, heavy-volume buying often precedes a significant news event, perhaps an unannounced design win in the automotive space or a validation from a major data center operator. The market is sniffing out a potential catalyst. Furthermore, we have to consider the institutional sentiment, which has been a battlefield. If you look at the 13F filings from the last quarter, the picture was messy. Some funds were initiating new positions, likely tucking NVTS away in long-term portfolios, maybe even within specialized Fidelity mutual funds or Fidelity IRAs focused on disruptive technology. But at the same time, the short interest on NVTS has remained stubbornly high. A lot of very smart people on Wall Street are betting against this company, believing its valuation is untethered from its profitability path. Today's 8.02% spike could be, in part, a mini short squeeze. As the price ticks up, those short sellers are forced to buy back shares to cover their positions, which in turn pushes the price even higher. This creates a feedback loop that has very little to do with the company's fundamentals and everything to do with market mechanics. It's a technical move, not necessarily a fundamental one, and it's why navigating this kind of stock requires more than just a SoFi trading platform. We also have to place this in the context of the broader semiconductor index. The SOX has been volatile, torn between the AI-driven boom of NVIDIA stock and the cyclical downturn in consumer electronics that has hurt companies like Apple stock suppliers. NVTS sits uncomfortably between these two worlds. Its technology is needed for high-performance computing, but its revenue is still heavily tied to the consumer charger market. This 8% move is outpacing the broader index significantly, which tells me this is an NVTS-specific event. The expectation is that all chip stocks move together. The reality is that the sector is fracturing, with intense divergence between the AI winners, the automotive and industrial suppliers, and the legacy consumer-focused names. Navitas is trying to prove it belongs in that first category. This is the kind of insight that investment help should actually provide, not just a list of hot stocks. For those who may have just put NVTS on their watch list via their Fidelity Investments or Schwab Intelligent Portfolios account, let's be clear about what this company actually does. Navitas designs, develops, and markets gallium nitride power integrated circuits. Unlike many competitors who sell discrete components, Navitas integrates the GaN power switch with the brains, the driver, and logic onto a single chip. This GaN-Fast and GaN-Sense technology is their core intellectual property. The expectation is that this integration makes their chips easier to use, smaller, and more efficient than a multi-chip solution. This is why your new 100-watt laptop charger is the size of an old phone charger. Navitas was a first mover in this mobile market. The reality, however, is that the mobile market is a low-margin cutthroat business. The real value and the company's entire narrative shift is focused on moving into high-power applications, data center power supplies, solar energy inverters, and onboard chargers for electric vehicles. This is where the margins are high, the power savings are critical, and the design win cycles are long and sticky. Today's 8.02% move is likely tied to a perceived win in one of these markets, not the mobile phone space. Looking at their last earnings call, this expectation versus reality tension was on full display. Management painted a picture of a massive, expanding pipeline of design wins in these high-power markets. They talked about their new silicon carbide technology, acquired to complement their GaN technology, and how it provides a total solution for EV makers. The expectation they set was one of exponential growth just around the corner. But the reality, buried in the numbers, was the guidance. The forward-looking revenue guidance was cautious. Why? Because management understands what the casual market does not: the lag time. A design win in the automotive space is fantastic, but it might be for a car model that doesn't go into mass production for 2 or 3 years. That means Navitas has to spend the R&D and support costs now for revenue that won't show up in their Fidelity brokerage account for 12 to 16 quarters. This cash burn is what spooks investors who are used to the instant gratification of software or Robinhood crypto trading. This brings me to the core question for the future. The bullish scenario, the expectation, is clear. GaN adoption in data centers becomes a mandate for green computing. EV manufacturers, desperate to extend range and reduce charging times, adopt GaN and SiC solutions en masse. Navitas, with its strong IP portfolio and first-mover advantage, scales its manufacturing and captures a huge chunk of this multi-billion-dollar market. The stock price, even after today's 8% jump, would look incredibly cheap in hindsight. This is the future that long-term investors, perhaps using SoFi active investing or Interactive Brokers stock trading tools to build a position, are betting on. But the reality is that the path there is full of risks. The primary risk is competition. The 800-pound gorillas of the industry are awake. Texas Instruments and Infineon have manufacturing scale and client relationships that Navitas can only dream of. They can afford to slash prices to win a contract, turning GaN into a commodity before Navitas ever reaches profitability. The second risk is adoption speed. Are these industries really ready to rip and replace their trusted, proven silicon designs? A failure in a data center or an EV is catastrophic. The validation process is long and intensely conservative. The third risk is macroeconomic. If high interest rates continue to stall data center construction and cool the EV market, it doesn't matter how good Navitas's chips are. Their customers will simply stop ordering. This is not a stop